Hello and good morning, folks. This is Almus Market Mornings, your daily dose of global financial updates with us, Shikhar, and I have JK with me today. A well discounted rate hike puts the market participants at somewhat ease as no new surprise is expected, at least for another 2 days. A 75 basis rate hike was all but discounted by the market participants, and though the currencies had some bit of a move before the central bank action, it was majorly seen that they came back to normalcy. Now, the major commentary by the Fed remained more or less same, but we saw some slight tilt towards dovishness. So, JK, what do you think? What should we be making out of the Fed's action and the commentary yesterday, and how would the markets react to it?
Yeah, so I think this was a meeting that was quite different in terms of the violent moves. The headline from FOMC was widely as expected, with policy rates being risen to 0.75%. But the reaction of the market was not quite as expected. But the investors took it with both hands. While the statement accompanying noted that indicators of spending and production have softened, removing earlier phrase of activities been picking up and supported the markets, it was the press conference that really added momentum to the market rally. Overall statement and his press conference were neither too hawkish nor dovish, but market definitely took it positively. The most telling statement for the market was when Powell said we are getting closer to where we need to be after front-loading hikes, and at some point it will be appropriate to slow down. While saying that FOMC remains strongly committed to fighting inflation to bring it down to 2% goal, he ditched forward guidance as to the quantum of tightening in the meetings ahead. Instead, he actually said that incoming data, including to see whether the economy was slowing down as needed. Decision for September will be made based on the data, and it was time to go to meeting by meeting basis. Overall, it was clear that US economy was not in a recession, taking the strong labor market as evidence, and that the Fed intention was to achieve soft landing. Even on a pointed reference to GDP numbers, which had printed negative in the first quarter, he said that these numbers more often get an upward revision later. And overall, it was a well balanced decision and statement that the market seemed to like a lot. Uh, Fed sounding somewhat dovish, with reading it as an indication of slowing down rate hikes, coupled with good numbers from Microsoft and Google yesterday, helped market to stage a smart rally. Dow 1.37 up, S&P 500 2.62, and Nasdaq 4.06%. That's a stunning rally, actually. This is notwithstanding the fact that we have seen the most aggressive series of rate hikes after 1980s. So possibly market getting to a stage of, we are closer to a terminal rate kind of thing. But the risk rally has not been carried into Asia in the same vigor as some of the US tech companies like Meta and Qualcomm fell heavily in the Asian trading. The outlook for the market remains positive, at least in the near term, because the market is now more or less calm as to the future rate hikes, and unless the data turns very positive and inflation remains at the same levels, then market may have to rethink their strategy. Otherwise, if the inflation is cooling down along with cooling down of consumption and activities, there could be pricing out of much more rate hikes than 3.5% as the terminal rate. Also, on the perception that Fed may be closely, possibly cutting rates in late 2023, yield curves steepened. Twos actually fell. It's a short-term rate, whereas the 30-year yield went up. And all this happened when the short-term yields have been falling and long-term yields going higher. Is a perception that rate hikes may end sooner than perceived. So that's a good thing for the market, and also for the non-dollar currencies, which have made somewhat of a recovery yesterday. In fact, it was not a day for the dollar bulls as the greenback posted losses against almost all the currencies, majors and EMs, apart from losing out to gold, which rallied by 1%, taking cue from the covert dovishness of the chairman. Dollar weakness was no more evident than in the end, which strengthened nearly 0.7% overnight and carried into the Asian time, falling to as low as 135.20. Market really looking at the short-term fall in yields. In fact, the dollar yen moves is very closely correlated to the 2-year yields in the US. And as 2-year yields have fallen now, dollar yen has also taken a hit. This is notwithstanding the fact that 10-year yield in Japanese JGBs have come below 0.2%. And the latest statement from Japanese Finmin says that they have to continue with the easy money policy. So the dollar yen really not keeping up the rally after yesterday's Fed meeting. Euro, of course, recouped nearly all of its prior sessions decline, which was one of the biggest drops in the last 2 weeks. But fears of European recession remain high as Russia further slows gas supplies through Nord Stream. So even if we do see a dollar continuing to soften, the same may not be reflected so much in the euro, and it can be an underperformer with the market convinced very well that the gas crisis and the political woes in Italy would push the region into a recession by next year. The action cools a bit on Thursday, rather today, though we will see a trio of data releases. We have the weekly jobless claims, and then first look at the Q2 GDP also. GDP is expected to have been at 0.5% annualized after minus 1.6 for the first quarter. The last batch of indicators leading to GDP, that's the durable goods orders and the trade numbers yesterday came better, improving the expectations for a decent number. But if there is one currency which is unlikely to be independently, which is likely to be independently weak, like the euro, it's the rupee. Both of them will likely underperform, even while the DXY is expected to lose more. Yesterday's session saw the INR push towards 79.90 again, as importers were more anxious ahead of the Fed meet. But even after the dovish message from Powell, in offshore trades, at least the rupee did not break 79.80. Should the dollar's overall trend get entrenched, we may expect authorities to make some opportunistic policy moves to improve the flows. But I think it's too early to say that the dollar uptrend is over. It's just one day's fall. Of course, if we do get any such moves from the government or the RBI, we can get a meaningful retracement for the rupee. In the short term, 79.90 should hold the upside. And if we break 79.70, another 10 paisa move lower can be seen. As someone was saying, every 10 paisa lower, we have a support. And every 15 paisa higher, we have the resistance. That's how the dollar rupee has been right now. Yeah, look forward to 2 more days of big numbers from the US, the GDP today and the core PC data tomorrow. Have a good day. Thank you.
Okay, JK, wonderful. And I really like the bit you mentioned that everyone's talking about 10 paisa down support, 15 paisa high resistance. I mean, looking at yesterday's action, I think those ranges would also look to be quite wide because there's no action at all when it comes to currency. So quite a steady day we had yesterday, but let's see what sort of actions can be expected with small correction expectations at JK, as JK mentioned. One of the things that has been somewhat constant in our regular podcast updates, folks, is the fact that we expect the end of rate cycle sooner than the expected. So let's see how and where does this neutral rates arrive at for the central banks. It would be an interesting outtake since the commentaries have started to change with the softening economic indicators. That's it for today. We'll come back again with another round of updates tomorrow. Keep listening to us. Thank you so much for joining.